In this video, we're going to discuss all things loan rates and the rising loan rate environment when it comes to life insurance contracts. And so what we're going to do is talk about why loan rates have increased, what that means for the policy, is this good, is this bad, and all things relative to the current economic environment. Today, at this moment in time, it's July of 2024, so things can change. So if you're watching this video later in the future, the economic environment changes rapidly. So this is for today's environment, but can give us a general idea to learn a few things of how things can transcribe and change. And also into the future, if you're watching this, the principles will stay the same. So with that being said, my name is Dom Rufran. I've helped thousands of people financially. I've been in the financial industry for over a decade now. I've helped put in over $100 million of life insurance, cash value in force, with over $1 billion of death benefit in force as well. And I've looked at thousands of illustrations, done thousands of life insurance calls, and been asked thousands of life insurance questions. And so taken deep dives with these insurance companies at loan rates, dividends, and all things life insurance. And that is why we created this And Asset channel, to talk about all things life insurance and how it could fit into your financial portfolio and help you live an intentional life. So with that being said, let's go ahead and dive into rising loan rate costs. All right, so first of all, why have loan rates risen? Well, the easy answer is life insurance companies' loan rates really follow the Moody Bond composite. And so over time, you can see that loan rates have been extremely low because the Moody Bond composite has been extremely low over a long period of time. If you look even prior to this, they were relatively low as well. If you look at even the 1980s, it was extremely high. You saw Moody Bond composite in the interest rate environment hovering in 10+%. And you also saw dividends increase, which we're going to also look at, but you also saw loan rates relatively rise as well. And loan rates are more reactionary as the interest rate environment, Moody Bond composite, increases rapidly. Loan rates can react quickly. And we're looking, talking about dividend rates. And so this is your first time at the channel. Dividend rates are something that you receive as profitability of the companies. They essentially pay you a dividend just by being within a mutual carrier insurance company. And so dividends are the crediting rates. It's not necessarily the net, it's a gross number, but those will grow slower and loan rates will increase more rapidly, but they a lot of the times will increase and decrease together. As time has happened, the loan rates have increased because the Moody Bond Index composite has also increased over time. And so when we look at it, we can see that 2022, 2023, 2024, the adjustable loan rates went from 4%, 5.7 to 6.2 because every single year the curve has increased on the Moody Bond composite. So therefore the adjustable loan rate as well. But you can also see that the dividend rate, though, 5.75%, has relatively stayed the same for a lot of the companies. And now they're actually starting to increase their dividends because the loan rates and the Moody Bond, the interest rate environment altogether are starting to increase as well. And so let's talk about real quick just the average loan rates across the board as of July of 2024. And so average credit card, 24%, HELOC, 9%, line of credits, 8 to 10%, brokerage, you can borrow against your brokerage account, 8 to 10%, mortgage rates, buying a home, 7.5%. Some of these will obviously depend on credit. Life insurance does not depend on credit at all, but it's around 5.5 to 6.2%. So historically, and this usually is just across the board, but it doesn't really matter the economic environment, life insurance usually has some of the lowest loan rates across the board, which is why it's a great tool to borrow against and use for another asset producing activity. Why borrow at 24% when you can borrow at 5.5%? All right, so why do insurance companies follow the Moody Bond Index? Like, it's kind of an important thing to just kind of get out the way as well. Life insurance companies, they're generally investing 75% of their funds to bonds. Bonds are safe, protective. This is why the insurance companies have been around for hundreds of years, because they've been able to invest conservatively and not have to risk a big portion of their funds. So they are very smart when they're coming to the investment side of things, and also very conservative. You don't want to obviously leverage tons of your money in high risk assets when you need the money to pay out people from a death benefit perspective. So they've taken the long call, and because of their majority of their money is in it, they're also following it, right? Because the Moody Bond's going up, and therefore the loan rates are also going up. And the reason why that is the case is because policy loans are also like the investment piece for these insurance companies. So they could either put their money into the bonds, or they can put their money into quote unquote policy loans. They're going to have to put a piece of it, right? Because on average, 6% of life insurance holders are taking loans against their policy. So 6% of their general fund is going to life insurance loans. So if life insurance loans are, let's just say, at 2% and the Moody Bond index is at 7%, well, that's a 5% delta that they're missing upon, right? And so here's the example, like they're missing out on a lost opportunity cost. They don't keep up with that. So Moody Bond is 5%, charging 3%, it's missing out 2%. So likely what they'll do is they'll keep on the loans as they do with the bonds at the same exact time. So just kind of conceptually think about that, is these insurance companies are a for-profit company, and they're obviously going to consistently do their best to stay profitable, which you do want them to be profitable, because that means your company is going to be around a long time. They're going to pay your death benefits out. And also with your mutuality perspective, they're going to be paying you dividends accordingly as well. So what does this mean? At the end of the day, is this good? It's kind of what I just touched about. At the end of the day, you have two types of companies: mutual companies versus stock companies. The stock companies, they're going to benefit the stockholders, and the mutual companies are going to benefit you of a mutuality company. They're going to give dividends to the policyholders within their profitabilities within that side of things. And so as the loan rates go up and you borrow from your policy and you pay them interest, these companies are making money. So in a roundabout way, by the interest rate environment actually increasing and the loan rate environment actually increasing, and you paying the insurance company the loan interest, you are actually benefiting from that to some degree. Right now, I think you kind of have to still look at that from a cost perspective, right? If I'm borrowing funds and my loans is higher at 7% versus 3% or 4%, which is a lot of them were at, there were actual lines of credits you get from 3%, using your policy as collateral. That's still a pretty big delta between 3 to 7%, right? So at the end of the day, if we're borrowing today at 7 versus 3, you could see it was better, but there is still a benefit, because what's happening is you are getting a dividend, the company is becoming more profitable, and the dividends are also increasing as well. So like I said at the beginning, they all go together. So interest rate environment goes up, loan rates also go up, dividends also go up. So it kind of becomes a co-tandem how all things work together. All right, so it's kind of what I just said. Higher loan rates, higher company profits, higher dividends going back to you. And here's some of the dividends versus the at the end of the day. Let's look at the dividends first over the last 1989 to 2024. So it's essentially almost a 30-year window. It actually is a 30-year plus window. And then we can see how these dividends have changed with the interest rate, which I'll show you the next screen will give us more of that index. And so here, let's just take a look at Guardian. I'm really looking at some of the big four mutual carriers, and then Ohio National just happened to slip into here as well. So big four, most behemoths of the companies in this space: Mass Mutual, New York Life, Northwestern, and Guardian. Ohio National is actually like a demutualized company, so we want to completely ignore this one. But I do think it actually gives us a good idea of just like how they've performed over time too, with their dividend declining to 4%. Okay, so look at 1989, you had 11.5%. So like I was saying a little earlier, was the interest rate environment was extremely high then. Dividends were almost 11.5%, which means I don't know the loan rates exactly, but I could probably guess that the loan rates are probably right around 11 to 12% as well. Like you said, they usually stay pretty close to each other, and that's across the board. So as the interest rate environment decreased, right, from 1989, interest rate environment decreased, and over 20 years, the environment just kept going down and down. And now, as of within the last year, the interest rate environment has gone up. So you can see now the dividends are also starting to increase again. So you can see this one went from 5.75 to 5.9. This one went from 5.8 to 6. This one to 6 to 6.1. And so you can see over time they're going to, in 2025, there's a likelihood that all of these companies do increase their dividend once again. And so when we look at the 10-year treasury, which essentially is, looking at it from a bond perspective, you can see the same thing that we were discussing. It's like, okay, 1980 to 1990, so that 1989 perspective, we got as high as like 14%, right? So if we go back and we look again at 1989, 11.5, and then you go forward, 1989-ish, you're here again. From there, the rates continue to decline. Boom, we got to here at this point in time, 2020, and then they started to go up again. So you can see how they're very correlated with one each other, right? Same thing here, down, and then starts to go up again. All right, so it's proof showing that they're very correlated with one each other. It's exactly how they work, proofs in the pudding. All right, as we just kind of wrap this up, because I just wanted to, I think the main points was to get across was that as the interest rate environment increases, dividends will also increase, but so will loan rates also increase. And that's really how this works, because life insurance companies put 75% of their investment dollars into bonds. If that's the case, is this good? Is this bad? I think it really becomes indifferent, because the policy performance becomes better, even though the loan interest rate also increases. And so there's like the give and the take type of deal. And then you being mutuality, you get more of the profits, higher dividend. And it's just kind of this like cycle. The other thing that I want to like really put into practice and practicality when we're actually looking at our life insurance policy and what this really means. And I think how you can take advantage of this. I think right now is a great opportunity to take advantage of fixed buckets, right? So fixed buckets, life insurance is a great fixed bucket, money markets, high yield savings accounts. Like these are all really based around how the interest rate environment performs, which is why CDs and money markets were at like 0% for so long, because the interest rate environment was so long. And now that the interest rate environment has increased, all the other fixed buckets have increased. It's the same thing with life insurance as well. Cool part about life insurance is it's usually going to get, on average, a higher return than a high yield savings account in a money market. Just long term, you're going to see 4 to 5%, regardless if it's a low interest rate environment, high interest rate environment. You'll still see a strong growth trajectory, and you're not going to see like a 0% returns as time goes on, because there's guarantees built into it, and these insurance companies are still paying the dividends as long as they stay profitable, which we want to make sure that we use companies that are profitable year in, year out, been around for 100 plus years. It's important that you pick the right company as well. And so as time goes on, what's going to happen is 2008s are going to happen, 2000s are going to happen, COVIDs are going to happen. There's an inevitable downturn that's essentially coming, right? So in this time, we can store safe capital inside of things like high yield savings accounts, inside life insurance, let that grow and compound. And then when we have opportunities like COVID and opportunities like 2008 happen and tank, we can then deploy that capital because our account has grown, and kind of not really take loans right now. I'm not telling you should or shouldn't take policy loans right now, because if you have a great opportunity from an investment perspective, you should. But what's likely going to happen is that with loan rates being so reactive, the Fed usually cuts a lot of the time. Like if you look back at history, the Fed usually cuts, especially right before a massive downturn. A lot of the times you can look back and you can see it's always happened. In the COVID 2008, all those times there was a lot lower interest rate environment, which means loan rates will go down. So things are on discount. Loan rates should relatively go down. You could borrow against and buy other assets on discount, and just be prepared for that to transpire. And at this point in time, if your loan rate is at, let's say 6% with life insurance company, but there's another opportunity where you're getting 15, 20%, 10%, anything above whatever you're borrowing at, you always win as long as you're responsible with what you do with taking the returns and paying back the policy loan, paying back the interest, and then rinse and repeating at the end of the day. Now, if my loan is 6% and I borrow to then put in a 4% asset, like now it's not great, because I'm losing out on that 2% delta. So anytime that we can borrow to gain more assets, increase cash flow, get tax advantages, do the things like that, and using our policy as that foundational asset to do so, you're going to win at the end of the day. And so with that being said, thanks again for taking the time to watch. Please subscribe. And if you have any questions, please let us know in the comment. Be more than happy to respond and answer.